And joining us now is partner at Element Wealth, Jeremy Nelson. Jeremy, good to see you.
Always a pleasure, Gerard.
And thanks for coming in. I'm hearing all kinds of good reports. I've listened a couple of times to your show.
Oh,
that's
thank
airing
you.
on the network.
Yeah.
So
Sunday
you
mornings at
that?
8:30. Yeah, it's fun.
Yeah.
Just a little something different, and get to give some practical advice and talk about just tips and strategies for saving, and give listeners an opportunity to call in, meet with us. So it's been really good.
Yeah. So the reason for our meeting today, our interview today, is it's tax day right around the corner. Comes around this time of year, unfortunately. So it's April 17th.
18th.
18th? Oh,
yeah,
well,
okay. There's some
18th,
weird holiday on Monday, so it's like Tuesday.
I thought the 18th was for those areas affected by the tornadoes.
That's right.
The storm. I think
or if you live in Jackson, the water.
Okay.
Yeah,
the rest of us are the 17th. Yeah. So you get another day.
I got an extra day, I think, yeah.
Okay. But that's because the 15th, which is the traditional April 15th, mm-hmm. That's like the start of vacation for the accountants. They look forward to that, and they have a big blowout typically on the night of April 15th. So that's coming up. Yep. What should folks be doing to prepare for tax day?
Well, number one, make sure that you have all of your information to your CPA so that they can get it in on time.
Or your tax preparer may not be a CPA.
Might not be a CPA.
Yeah.
Make sure you're getting that in. And at least, being prepared to file your extension. And because you want to have even if you're filing an extension, you want to have an accurate estimate because you don't want to underpay taxes, right? And then be penalized later on. So you really want to have a good handle on, what your overall tax liability is going to look like. And then, if you're self-employed or if you've got the ability to fund IRAs or HSAs, things like that, you've got up until your tax filing day to fund those retirement vehicles or HSAs to reduce that tax liability. So you want to make sure you give your tax preparer CPA a few days to look at it to let you know, hey, here's how much you can put into a SEP IRA or an IRA or an HSA to help you control those tax liabilities.
Yeah. So the IRS is reporting that it expects lower refunds this year, and that's mainly because of all the various programs that were temporary during the COVID era, the American Rescue Plan and so forth, which implemented a number of tax credits that you typically aren't going to see and receive and be accounted for until you do your return, send your return in.
Yep.
In which case you're going to show a refund due. So they're saying that that's down. Expected to be down this year. Of course, not sure how you feel about this. I've always felt like I don't want a refund. I don't want the government to use my money. I want to make sure that I'm only paying in the minimum to stay out of trouble with the IRS, and I don't want a refund.
Yeah, look, I am one that says, look, I basically want to have paid in as close to the appropriate amount as possible. You don't want to be – I mean, today, right, think about, with interest rates and money markets at 4%, if you have a huge amount of money sitting with the government, well, you haven't been collecting your 4% that you could have been a money market, right? So you're much, much better off to, pay an accurate amount and then settle up at the end of the year.
Yeah. So I am reading, it does look like you're right. April 18th is the date, right?
Yeah, I just double-checked.
Yeah. So I'm sorry, I got that wrong. So, and it has to do with Monday. There's something special about Monday.
Yeah, there's
right?
some holiday. I don't know what it is. I mean, I feel like there's a holiday like every month now. That is just some random holiday, and I think it's because federal workers want the day off or something.
Emancipation Day.
Okay.
April 17th is just check the IRS site, is Emancipation Day recognized in Washington, D.C.
Okay.
So where the IRS is located. So the 15th falls on a Saturday. Emancipation Day is Monday, the 17th, and thus the tax returns are due on the 18th. So you got little breathing room. But also, I thought there was some extension granted for those in the areas affected by the storm. I thought there was, maybe that's state.
I've seen conflicting reports, but some reports have them given an opportunity to wait until June or July at the latest.
Okay. We'll do a little research on that. But nonetheless.
Yeah, I'm pretty sure that because Jackson proper was in, which I'm lucky enough to live in and don't have garbage pickup.
Yeah.
But I believe that if you're in Jackson proper, that there was an extension because of the water crisis.
Could be, yeah.
Which
But
I don't know what that has to do with taxes.
But I think that may apply to state.
Yeah.
Not federal.
I just found it. It's taxpayers in storm-affected areas of Mississippi now have until July 31st to file various federal, individual, and business returns to make tax payments according to the IRS.
All right. And that would, I guess, include the city of Jackson because of the water. So federal as well, right, Rhino? What you just read.
That's correct.
Okay. All right.
What would we do without Rhino?
Well, I don't know. He's pretty nifty looking all that junk up there. He's pretty fast. He's like a chat GPT prompt machine for Google. So that's you watched there's going to be a whole curriculum around chat GPT or AI, generative AI systems prompts. There'll be a whole curriculum around it. No doubt about it. It's coming. So, all right. And I actually think that we'll eventually get to the point where tax preparation will be completely automated.
I can see that.
There's some things that I think still require some human logic and analysis, but it's fairly close to that now.
Yeah,
tools.
if you just have W-2s and normal mortgage interest and things like that, you don't have K-1s and things for your tax returns. It's pretty simple to put it in TurboTax.
It is. Agree. But I kind of envision a point where all of that input data is just automatically integrated in without the need for you to have to enter it.
Well, think about like on your iPhone, right? Face recognition and things like that. So they can use that software if you just scan the document to pick up the data.
Well, I've seen it be more of an electronic interchange where all the folks who have to send you these various documents where your income is recorded. Mm-hmm. And reported. That just gets reported electronically into the systems. But so, all right. So tax day, you talked about that. Let's talk about the markets. The Fed raised rates 9 times since it started the Fed hiking campaign.
Yep.
We went from 0 to 5 or so in a very short period of time. Mm-hmm. That has wreaked havoc on the banking sector.
Yes.
And just try to explain that in layman's terms. A lot of the banks were investing. Banks make money by loaning or investing, and they invested in long-term, long-duration bonds at higher interest rates. Normally, if you park your money for a longer period of time, you get a higher return, higher interest rate. Mm-hmm. Well, that's all great, except within a few months, the interest rates went through the roof on new issues of those same duration bonds, which made their old bonds they're sitting on for 30 years less valuable. That, in a nutshell, is what caused the liquidity crisis.
Yeah, basically you had, like Silicon Valley Bank held all of these long-term bonds. So for our listeners, think about, if you owned like AGG, right, the aggregate bond index ETF, it was down 13% in 2022, right? And that has a duration of about, 6.5 years. So they had 10-year treasuries and even longer in their portfolio. So think about how much those went down in value. And, they were holding them at book value, what they were going to mature for, instead of holding them at what they were really marked at. And when people started pulling money out, they had to sell these things at the discounts, which created the massive losses and the insolvency.
Yeah. So just for our audience, the way it works is if you're sitting on a bond, it's 30-year bond, and it's paying 3%, but I can go buy one at the Fed window today that pays 5%, as an example. Mm-hmm. And all of a sudden, I got to sell that bond because I need the cash. Because banks don't necessarily buy bonds and hold them to maturity. Yep. They're tradable assets, and somebody's managing all that. Well, when they go to try to sell that 3% bond in a market where an investor can get 5% on a new one, they're going to have to take a big old haircut on that 3% bond. Yep. If they bought it for $100,000, they may have to sell it for $80,000.
Yep.
Which means they just lost $20,000 on that investment.
Exactly.
That, in a nutshell, is kind of what happened, wasn't it?
Totally. That is exactly it.
Man, well, what a big old mess. You can hang around with us, can't you? Because
absolutely.
I want to ask you your thoughts on, and we'll catch this on the other side of the break. We need to transition to a mark-to-market model in the banking industry, in my view.
Totally agree.
I'm interested to hear your thoughts on that. We got Jeremy Nelson from Element Wealth in the Element Wealth studios, and we're coming little Pink Floyd money with a money guy here, Jeremy Nelson, Element Wealth. So I don't think we're just talking about the mark-to-market stuff, and it's complicated. But had SVB, had they been adhering to or required to adhere to mark-to-market principles, all that long-term debt they had on their books, they would have marked to market as part of their financial statement presentation, and then they would have showed huge losses.
Yeah, so on the investment front for banks, right, you have assets that are subject to mark-to-market accounting, and then you have assets that can be considered held to maturity. And so high-quality bonds, treasuries, things like that, they were able to consider those held to maturity securities, so they didn't have to reflect the losses, the market value, right, the difference between what they paid and what they could sell it for.
Yeah.
They didn't have to reflect that in their earnings.
Yeah.
So, but the reality is, I think you and I were just talking, if they had to mark everything to market, then that would have been well known. And I don't think that they would have taken that risk either.
Exactly.
At that point in time. Or they would have hedged that interest rate risk potentially.
Yeah, they would have been forced to hedge it, and they would have had to be a whole lot more careful with their investment selections. They wouldn't have dumped so much money in these long duration bonds, because we all knew that this nonsense about inflation is transitory wasn't going to hold, and we knew that as a result the Fed was going to raise rates, which would devalue their bonds.
Yeah, like we were talking about this over a year ago on the show, right? And ultimately anybody could see that a 6% inflation rate in December of 2021 and a 1.5% 10-year Treasury, like, this didn't make sense.
Yeah.
Now, did you think you're going to get 9 straight rate hikes and go up to 500 basis points as fast as we've ever gone? No, not necessarily, but you knew something was going to happen.
Yeah.
You knew there was going to be an impact, and it doesn't take a math genius to do the calculations as to how much a long-term bond is going to go down if rates go up 100 or 200 basis points. It's shocking to me that the regulators didn't see this, that the auditors didn't
they did,
up.
Jeremy. I mean, these are smart people.
Or at
They
least
knew all this. They didn't speak up.
That nothing was said. And what it comes down to is that there's a difference in the stress testing that regional banks have to go through versus the systemically important banks.
Yep.
Right? And now
SIBs, they're called.
The SIBs, Yep. So that's the J.P. Morgans, Wells Fargos of the world, right?
Bank of America.
So I think that now there's a counterpoint to this that says, so you could say, well, let's put the same regulatory burden of the J.P. Morgans on these other banks. Well, that's going to crush community banking. So that's not necessarily a good thing, right? Because one of the great things about the American banking sector is that it's very localized, very regionalized, right? There are loans that small business loans or different things, land deals that you can go to your local bank and get done. And if J.P. Morgan and Wells Fargo and Bank of America were the only banking options that we had because no one else was in business, they wouldn't take those deals because they don't move the needle.
They don't. That's right.
So having that localized banking sector is great for the American economy because it provides more credit. But when you see issues like what happened at Silicon Valley Bank, you go, well, we do have to have some sort of a regulatory response to this.
Right.
Now, I don't think that this is something that we'll get through this, and I don't think that we'll see it again. Right? It's just like
No,
you
don't see any more bank failures?
No. I think there are more. Warren Buffett even came out and said.
too.
So I think that there's still some more here, but I'm saying we'll get through this episode.
I got you.
Right? And then on the back end of it, I don't think you're going to see banks making the same mistakes, just like they're not doing ninja loans right now.
Well, in fact, I know you've seen the reports that are in the last 2 to 3 weeks, we've seen the largest decline of new loans being originated by banks than ever in our history.
And this was one of our big points to, hey, we talked about this, I think, when I was in Las Vegas on spring break, right? I webbed in. What we said at the beginning of the year, we see a recession later in the year. And we think this advances the case because on our interview, I said, look, you're going to see banks pulling back now on credit. Right?
They are.
Banks, and the evidence is showing within a couple of weeks. It's only been a few weeks here.
Rapidly.
They are pulling back now.
Mortgage loans have declined. Origination of mortgage loans way down.
Yep.
The standard asset-based lending way down. I think a combination of being more careful, perhaps, trying to just keep their balance sheet in order.
Yep.
And all the above is at play here.
Now, I think the important thing, like there's going to be more stress in the residential housing market. There's probably going to be some stress in the commercial markets, although the publicly traded REITs, I think, are already pricing a lot of that in largely. I think a lot of them are probably trading below their intrinsic value.
That's real estate investment trust, by the way.
But, for investors, the one thing to remember is, it's a marathon, right?
Right.
But and going all in and all out and panicking and being emotional typically never works, right? Really focus on quality because there are still there's a lot of quality assets out there, and if you allocate properly, you will ride through the storm.
Well,
right?
So the good news you and I have talked about, and I have a question here on the C Spire text line, is that there's a lot more opportunity for just standard income producing assets to generate a lot more return than you could even a year ago.
Absolutely.
Right? So,
I was just on a web call before this with a client in France, and that has assets here, and I mean we're like 6.5% yield on that portfolio.
Yeah.
Not bad. I was I had a meeting with Fidelity this morning. I had a breakfast with them, and we're looking inside, like regular core bond funds, and they've got yield to worst at 6%.
Unbelievable.
So, look, there are still a lot of options, and I think that, you probably want to have a little bit less risk in your portfolio today. You want to be a little more high quality. I think that, core bonds are a really, really good place to be. They're going to provide ballast in the portfolio. Don't be scared from what happened last year because that was kind of a one-time thing. That's not something that's going to happen every single year. Yeah.
So the question was, and I know that we have talked about this before, you can't really give just direct investment advice, but the question is, what do the little guys with a little disposable income need to be doing right now? Finding 4.5% CDs pretty easy, nibbling on ETFs. And so I think that what you could say is that, there's a lot more opportunity to invest in fixed income securities, very low if no risk, and do pretty well.
Yeah, so depending on where you are in the life cycle, are we closer to retirement or are we in the early accumulation? If we're in a more accumulation phase, look, basic dollar cost averaging, big advocate of international diversification right now. We see the dollar turning. We see a big run there. Look back to a period like from 2002 to 2007. We think it's going to be a good comparison. But the mistake people are going to make is they're going to flock into CDs. And they're not going to lock any duration in. And then what's going to happen? The Fed's going to cut next year. They're going to be forced to cut interest rates because we are going to go into a recession.
And that's the way you stimulate the economy.
And then you're stuck. Well, you could go in today and lock 5.2% in for 5 years in a multi-year guarantee annuity. It's like completely principal guaranteed. Or there's other principal protected options. So if you want to be super, super safe, know you can't lose money, there's better options than CDs, and you can lock in some rates, or you can go buy, high, investment grade bonds. Like I said, we're talking with Fidelity today and core bond funds with yield to worst of 6% in them. I'm taking that over locking in a 3-month CD because that rate is going to go away as soon as the Fed starts cutting, and then you're going to be back to square one.
This is something since I first started doing business with you, you discussed this option with me and highly recommended that we allocate some there, which we did. We've got decent investment there. And the most redeeming, I think, quality of those investments, besides you've got good return, is it's principal protected.
And think about this, like compared to a bond. So you didn't lose anything last year, and you had some liquidity that you could pull out of it. Well, if you were selling off your bonds like Silicon Valley Bank, you took a big haircut on anything you were selling.
Exactly right. So the point there is this is the kind of stuff you guys can help with. You know a lot about that. You know where those sorts of securities are available and how to help someone get invested in those. And it's a pretty dang good deal. And I made it clear to you as part of my investment objective, I want to protect principal.
Yeah. Let's protect it. Let's have some income, and let's build it.
Yeah.
Income growth and guarantees. That's our mantra, right?
If you want to hang, we come back and start talking about the economic future.
Let's do one more, yeah.
All right. We got Jeremy Nelson from Element Wealth in the Element Wealth studio. We got economic issues. You were saying off the air, and I totally agree with you. It's a great way to put it, that we're taking our eye off the prize. I often describe it as we're more consumed with pronouns and where to pee than we are the true issues facing our country and our world. We got hot spots across the globe. We got China saber rattling in Taiwan. These kinds of things affect investors, affect the markets. It's not just economic data, but it's geopolitical events as well.
Yeah, look, so here's my take on this. We are at an inflection point where, we're running a $1.3 trillion deficit today, right? We're running a bigger deficit than in the peak of the financial crisis.
Right.
Right. And, and look, this isn't just a Democrat thing. This has been under Republican administrations as well, right?
Yep.
So for many of our Democratic listeners, we're not just picking on you here.
Yep.
This is an issue where we haven't balanced a budget since the early 2000s. Right, and we continue to run deeper and deeper and deeper and deeper deficits to the point now where we have $31 trillion of debt. And you've got Social Security that is no longer fully funded.
Right. And Medicare. So you've got these big issues, right? And instead of our politicians actually looking at what's going on, right? And the Fed has basically bailed us out, right? The Fed has bailed out bad fiscal policy for 15 years since the financial crisis, right? Yep.
So the Fed was able to just kind of push, interest rates down and hold them down. There was no inflation, right? Asset prices grew. Everyone felt really good, right? Valuations kept going up and up and up, and our home prices kept going up and up and up and up. Well, the party's over. For the first time in 40 years, we have inflation, right? The Fed is not going to be able to go back to the same playbook in the manner that they did previously. So now all of a sudden, markets are going to have to readjust to more normal long-term interest rate policy, right? The Fed's got to potentially do something about their balance sheet. If the dollar starts declining heavily, they might have to, really do things to support the dollar. Mm-hmm. So you've got some real issues there, and politically, we're sitting around not solving the real issues and getting down to economic policy and tax policy and all these things, right? We're fighting about just crazy things. I can't. If you told me 20 years ago that this is the stuff that we'd be dealing with and fighting, I'd be like, you're nuts. There's no way. But here we are, right? So the eye is off the prize. And it's going to take we're not going to do anything until there's a crisis. And this could turn into a bigger issue down the road.
Yeah.
But this is not a one-time issue. This is going to be a multi-year period of time. I said this in 2018. I looked at the forecast of where we were going with deficits and what was going to have to happen with tax rates and how much we were going to be paying in interest on the debt. And we're there. Interest rates are up, right? And we're going to have there's going to be a bumpy road here.
So we've got we're still, I don't think, totally out of the woods with respect to the banking situation. Most folks in Mississippi, of course, they bank with regional or community banks. We don't have a big presence of the top 4 or 5 SIBs We don't have a lot of J.P. Morgan and Bank of America. We do have some Wells Fargo presence, some Citibank presence.
Chase has moved in
got a little bit,
now,
yeah. But overall, I think most of us, if we were to take a poll there, would find out most people bank with regional banks or community banks.
Yep.
Credit is tightening big time. We just talked about some recent reports on that. That's going to slow the economy down.
That is absolutely going to slow the economy down. And we're seeing things like credit card debt ticking up, to the highest levels we've seen in a good while. We're seeing the savings rate coming down dramatically. And although the unemployment rate is hanging in there at low levels, the jobs that we're losing are high income earning jobs, right?
True.
And that there's an economic impact to that. And I haven't really heard anyone talking about that too much yet, but I think that's a bigger issue. Now, I don't want this to sound like the Jeremy Grantham doomsday. This is a bigger bubble than 2000. I don't think that, right?
Yeah.
I think that we're just going to enter a period for potentially a decade where it's buy the dips and sell the rips, right? You're going to have to be a little bit more nimble, a little more tactical, really think if you're in retirement, thinking about your distribution strategies. I don't want our listeners to take away from this, I need to go, bury everything or buy gold, right? I'm just saying the environment's going to be different. You can see it setting up. It is happening. So you want to be forward thinking with what you're going to do from an investment perspective, not backwards looking, saying, hey, what worked the best over the last 10 years? Because what worked the best over the last 10 years probably is going to be the worst.
Gotcha. Well, and again, we got another question. What about the best investments in the short term for people in the 5 to 10 year from retirement? I mean, how do you allocate a portfolio? Some balance there.
So, I mean, I look at it like this. Like, let's say if I'm 5 to 10 years out from retirement, and I was in a target date fund, I'm probably 60, 70% equities in that portfolio. Maybe I want to be 40 or 50, a little bit of risk off the table, maybe a little more bonds. Hey, if things are good, I'm giving up a little bit of upside. But if things are bad, I'm a little more conservative. I'm going to hold on to more. And then when it's down, you can always readjust and go back up to that 60 or 70, right?
Sure.
That's the idea of buy the dip, sell the rips. It's not go all in, go all out. It's manage risk, right? Play it closer to the vest. Give up field goals instead of touchdowns.
Yeah, that's a good point. So point is there's still a lot of ways to make money in this market, in these market conditions.
Look, I'll tell you this. I mean, I am very, very bullish on investment grade corporate right now. We've been dumping high yield. We're a little bit concerned that credit spreads could blow out if we go into a recession. So we're going a little bit more high quality right now. If we're right, we go into a recession. That's going to create a nice opportunity to buy back high yield, right? We're focusing a little more on international diversification, right? Valuations across the globe are significantly lower. They're 2/3 to half of what the U.S. trades at right now. And they're actually, I hate to give France credit, but they're actually doing something about some of their issues, right? That's why people are rioting, because they're changing the retirement age.
Right.
And we're not doing anything here.
Right. We're just kicking the can.
They've been doing it since 2011.
True.
Since the European debt crisis.
So with respect to high quality, explain that to our audience. What do you mean by that?
So high quality. So if we think about the U.S. Treasury as, the risk-free asset, right? And so that's your AA plus, AAA, however, depending on the rating agency. High quality just means investment grade. Good, high quality companies, right?
Strong companies,
balance
good balance sheets. Right.
They're not going anywhere. They're not defaulting on their debt. High yield is when you start going, triple B and below.
A little more risk.
A little more risk involved with those bonds. Default rates are higher. You're compensated with more yield, but don't get sucked into that, right? You want to be a little more on the high quality side now.
Company experiences a hiccup and they default on those bonds, on those loan payments. You're sitting there with that principal bond, your investment, and you got high yield, but now it's worth nothing.
Yeah, and even within your equities, right? If we think about quality, companies with good balance sheets pay dividends, history of increasing dividends, right? Versus highly speculative stocks with big PE ratios.
Yeah. So, and I think most people understand the concept of high-risk equities versus low-risk equities. Yeah. Same applies to bonds, though.
Absolutely.
The same applies. So the other thing that's going on, correct me if I'm wrong here, is that we're seeing dividend-paying stocks get more aggressive with dividends, they're also having to compete somewhat with the fixed income markets.
They've got to attract capital, right? Because people are looking at it and go, well, hey, I can get 3.5%, 4%, depending where I am on the curve on treasuries.
With little or no risk.
Yeah, and so look, why don't I, instead of owning these dividend stocks, I'm going to go over here. Now, long term, that's a mistake. Now, you might get in the short term, it could work out because if the stock market goes down, you're going to look like a genius.
Right.
But long term, if you own companies that pay dividends or ETFs or mutual funds that have dividend-paying stocks, those companies are going to increase those dividends. So you actually have a rising income stream over time. Whereas if you're just hunkering down in the portfolio, those rates could go down.
Yeah, that makes sense. That makes total sense. So still lots of opportunities. I'm still bullish on America. I know you are as well.
Yeah.
We have a lot of great companies doing a lot of great things. We just got to get the dang government out of the way.
We will sort through this stuff. The end of days is not upon us, and that's what I want our listeners to walk away is, hey, look, there's going to be some challenges. You need to have a plan. But also don't panic. Don't be emotional.
Yeah.
Right? Be smart. Be logical, and manage your risk. You'll be okay.
And I know a lot of people that have written us today. They're approaching retirement, and they're nervous. They've seen their 401k plans and so forth decline in value. They're looking to protect their principal and make sure they got a way to live and stop working.
And there are ways to do that.
There you go.
Yep.
Jeremy Nelson, partner at Element Wealth, has been our guest. Really appreciate it.